All right, welcome to The Explainer. Today, we're jumping into a topic that honestly affects every single one of us: corporate taxes. Now, I know it can sound super complicated, but stick with me. By the end of this, you're going to have a really simple way to figure out if a company is actually paying its fair share. So let's get right into it. I want to start with just one number: $240 billion. Just take a second and let that number hang in the air. What on earth could that represent?
Well, that's what's lost every single year because of corporate tax avoidance. According to the OECD, that's somewhere between 4 and 10% of all global corporate income tax revenues. Just gone.
So obviously, this is way more than just some abstract number. It's a huge question of impact. Where does all that money go? Or maybe a better question is, where doesn't it go? And who feels that loss the most?
So yeah, every country feels this, but the pain is definitely not spread out evenly. For developing nations, this is a massive blow. Corporate taxes, they make up about 10% of their entire government budget. That's double what it is in developed countries. So think about it. Every single dollar that's avoided, it just hurts that much more. And this, right here, gets to the absolute heart of why this all matters. That lost money, it isn't just a number on a spreadsheet. It's the cash that's supposed to fund the very fabric of society that businesses totally rely on to even exist, let alone succeed. We're talking about the roads their trucks drive on, the legal system that protects their brand, and of course, the educated, healthy workforce they need to hire. Which brings us to the real core of the issue. See, being a truly responsible company isn't about doing what's technically legal. It's about moving beyond just following the letter of the law. Let's look at what that really means. This quote is pretty much the guiding principle for what the source material we're looking at calls a future-fit business. It's a simple idea, but it's incredibly powerful. It's not about hunting for every single loophole you can find. It's about making a fair contribution right where your actual business is happening. So, here's the crucial difference. On one side, you've got companies that just treat tax like any other cost, something to be minimized by using every legal trick in the book. But on the other side, you've got companies that follow the spirit of the law. They actually get that they have a duty to contribute to the society that allows them to thrive in the first place. And there's actually a technical name for all these strategies: base erosion and profit shifting, or you'll see it called BEPS. This is basically how huge multinational companies can legally shuffle their profits around the world. Move them from a country where they made a ton of sales to a country with a tax rate of like 0. This just hollows out the tax base of the country where they actually did all their business. Okay, so how can we, as just regular people, customers, investors, whatever, how can we tell the difference? How do we spot a company that's actually trying to do the right thing? Well, lucky for us, there's a pretty straightforward framework. Let's call it the transparency test. And it all boils down to these 3 pillars. 1. Does the company publicly state how it handles tax? 2. Is it totally open about its finances? And 3. Does it bother to explain how it got to its final tax number? Let's break each one of these down. First up, a public tax policy. A responsible company is not going to be shy about this. It should have a strategy approved by the board that you can find easily on its website. And it should say flat out that it will not use crazy avoidance schemes and that it will pay tax where it creates real economic value. And, this is a big one, someone on the board should have their name on it, taking responsibility. Killer 2 is what the source material calls enhanced, or radical transparency. This means making your full financial statements public, even if the law says you don't have to. It means being super clear about what you do, where you do it, and, crucially, who actually owns the company. No more hiding behind a maze of shell companies. And number 3, explaining the numbers. A company's headline tax rate, the one you hear about in the news, is often really different from the cash tax it actually pays. A responsible company will show you the math on that difference and then give you a simple written explanation for why it's different. It's all about showing your work. Now, for the really big global companies, this transparency test has one more vital layer. It's designed to let us see exactly how their money is flowing all over the world.
It's called country-by-country reporting, and this is designed to fight that whole BEPS problem we talked about. For every single country they're in, the company should be telling us its sales, its profits, its taxes paid, and even how many people work there. This makes it a whole lot harder to, say, claim you made all your profit in some tiny country where you have 2 employees and a P.O. box.
So, we've covered the problem, the principle behind the solution, and the test to see who's doing it right. But what does this actually mean for you? Well, as a stakeholder, and that means a customer, an employee, an investor, you have a real role to play here.
The next time you're checking out a company, whether you're thinking of buying from them or working for them, you can ask yourself a few really simple questions based on everything we've just gone through. Here's your checklist, nice and simple. Does it have a clear public tax strategy? Can you find its full financial statements easily? Does it actually explain its tax rate? And if it's a big multinational, does it report its business country by country? If you can't find this stuff, well, that's a pretty big red flag.
And that leaves us with one final big thought. At the end of the day, transparency is what accountability is built on. Companies that are actually proud of their tax practices, they're going to be eager to show you. They'll be open about it. So, if a company chooses to stay in the shadows, it's really up to us, right? As their customers, as their employees, as investors, we're the ones who have to ask why, and to keep on asking. Thanks for digging into this with me.